welcome to another edition of Investments in Focus. Today we have Gerald Tukach joining us from Millennium III. He's here to talk to us about the launch of their newest offering, the M3 Hazelton Properties Limited Partnership. If you have any questions about this offering or think it may be a good fit for your investment portfolio, please reach out to your private wealth advisor. Gerald, I'll let you take it from here.
All right, thank you for taking the time to view this recording. As Darren mentioned, I will be discussing our Hazelton Properties Limited Partnership. The OM for that offering is dated September 1st, 2022. As always, a couple slides of disclaimers. We are a fairly long-term company with a long-term investment, so we do like to point out that we are looking into the future. There is some forward-looking financial information, so keep that in mind. We like to say that we have got years of experience doing this, but not a crystal ball, so things can change, so just keep that in mind. We are looking kind of into the future. And there are statutory rights for every investor, so again, please do consult that offering memorandum. It's very important for you as an investor to know your rights. So the Millennium III business model in a nutshell kind of breaks down to four things. We're an investment into commercial real estate. And basically what we do is we take commercial real estate, so bigger kind of strip malls, industrial properties, small office properties, things like that, and we own them the way most people would own a half duplex, right? So we buy the property, we put a mortgage on it, there's tenants that are already there, they're paying us rent, the rent pays off the mortgage. One day the property is debt free and then it just becomes a cash cow, right? So that's the kind of investment in a nutshell, but there are kind of key components to that, right? So the first is that, again, we are a commercial real estate investment. So I mentioned the types of properties, but keep in mind it's a going concern. So we're not buying land and we're gonna have to build a property and then find tenants, all that kind of stuff. We're buying existing properties that have been around for a number of years already. Now, the reason that we look for properties that have been around for a number of years is we like growth-oriented properties. So we don't want things at their highest and best use. Things that are beautiful and glass and picture the downtown of any major city, that's for a different investment style, a different investment company, something that maybe is a public or privately traded REIT. We want the added value. So we look for properties that have been around for 20, 30, 40, 50 years, something like that. The previous owner, so they're functionally in good shape, but they're tired. They need some TLC to fix them up and spruce them up a little bit, right? So the reason that we like that is we can add value and increase rents for tenants by sprucing things up. So any of the costs that go into the refurbishing of fixing up the property and making things look better or making it more functional can be written off by the investors. So it creates a nice tax advantage. So I'll talk about specific numbers a little bit later in the presentation, but that's a large part of our investment business model is, there's not that many ways that we can kind of reduce our tax bill on an annual basis. So here with Millennium III, we found a way to do that a bit. Now, the final piece is that it's income producing. So as I mentioned, with our business model, it does start with a mortgage and we are fully planning on paying that mortgage completely off. We want to get these properties fully debt free because then at that point, there still should be rent coming in from tenants, but now there's no mortgage. So it just is cash flow to investors. So from a planning perspective, our investment really is, designed for a long-term income stream year after year after year after year. So of course, if it was perfect, everyone would be doing it already. So what kind of are some of the risks? Operating and leasing, right? So as I mentioned, we're buying existing properties, so it's about maintaining the leases, securing new ones, both property and property management costs and refurbishment. That all needs to be managed. So again, we've got 40 plus years of experience doing this, but they are legitimate risks in any business. It's going concern. There's things there's moving parts. We're a long hold period. So again, we're not shy about this. And what that really means for us is when people are doing portfolio planning, there's short-term, medium-term, long-term, there's diversification in geographic regions. We just want to be the long-term portion of somebody's investment portfolio, right? For those, business owners that maybe don't have a pension or for people that are just kind of looking at kind of income streams later in life, that's where we want to fit. We don't want to be an investment company that, buys a piece of real estate and then is selling it again in 2 years. That's not our business model. We're definitely designed for long-term holds, but it's probably a small portion of your investment portfolio, right? So that's why keep that in mind. What we might lack in liquidity and in having a long-term time horizon, we make up for in some tax deductions and income streams down the road. The final piece is the local market. So again, commodity prices may put negative pressure on rental rates. So again, that's something that, again, I remind people that cuts both ways. So the typical property that we have is either in the greater Saskatoon area or the greater Edmonton area. Both those economies, we like them very much. We think they have great both short-term and long-term potential. but they're commodities backed, right? So if commodities change, that could, weaken that economy a little bit, and then again, that can change rental rates. Now, again, the reminder is that cuts both ways, and you'll hear about this a little bit more in the presentation. When things are doing well in commodities or whatever the underlying economy has backing it, things also become quite prosperous. So something to keep in mind, but nonetheless, I'm presenting them as kind of risks and acknowledgements that we're making. So the company's timeline, we started in Saskatoon in 1981. As I'd mentioned, we've been around for about 41 years. Now, the first 7 years of the company were in building and developing residential apartment blocks. So anywhere between kind of 10 and 54 suites, right? So we did hold that for a number of years, but we decided for this very kind of long-term hold, we actually think commercial had a lot of advantages. So we switched our focus to commercial in 1987 and have never looked back. So the last kind of 34 years of the company have actually been commercially focused, okay? The next major change is that we shortened our mortgage life between 10 and 15 years in 1995. So if you like what you hear around here, but you think, geez, that's a fairly long time to pay off the mortgage, commercial properties just need that long to get them paid out. But believe it or not, before 1995, there were 25-year mortgage amortization. So it was really about maximizing that debt and taking a long time to get things paid out. But now we've got it shortened to between 10 and 15 years, and the current offering you'll hear about today is about 14. Final piece of the kind of timeline is that we began acquiring property in Alberta in 2005. So again, everything prior to 2005 was in the Saskatoon area. We expanded to Alberta, again, centered around Edmonton in 2005. The current offering that you will hear about today is a Saskatoon property. So again, we kind of buy properties in both of those geographic centers. Logistically, what we do is we get out and we set up a real estate syndication. So we go out and find these properties. We probably look at between 50 and 100 properties every year. We only bring kind of 2 or 3 to our investor base, but we buy that property, get the financing lined up for it, establish a limited partnership, and act as the general partner to that partnership. At this point, we distribute the units to limited partners. So that's kind of the process that we're at now, kind of doing presentations, discussing the opportunity with various potential investors. So again, we've already done all the background. So it's not really a speculative thing. I will talk about Millennium III business model because we keep that consistent from offering to offering, but you as an investor know exactly what you're buying, right? It's the business model plus this is the specifics of this offering, right? So we also provide the long-term management for both the property and the asset. So again, there's 2 different levels of that. So again, we have our own subsidiary property management company and an asset management company as part of what we do. And again, the goal is to achieve the best possible ROI for our investors. So if a wonderful dealing representative with Raintree had a property in Saskatoon that they would like us to manage, we'd say we'd love to, but unfortunately that's a conflict of interest for our investors. We can't manage it for you. We can only manage properties of our investor portfolio. And the final piece of property reversion. So again, as I'd mentioned, that kind of is what helps kind of create the tax deduction for our investors is when we're buying these properties, we are looking to invest in improvements to enhance the leasing potential. So we want to buy properties, where we can fix up the outside, the inside, do some work on it, whether it's cosmetic or functionality. We want to basically find a way to improve the value of the property so we can typically charge more rent to the tenants. And again, they're getting a better property for it. So it's a fair relationship in that way. But that's what creates that tax deduction. And that is what gets people's attention, especially at this time of year. Between now and the end of the year is where we kind of see a lot of interest in our investment model because tax planning is important. Our tax planning tool can only go until kind of mid to late December. It's not like an RSP where you can invest in it right till the end of February. This has to be done basically by mid-December. So again, something to keep in mind there. But again, we're writing off the partnership setup and refurbishment costs directly against other taxable income. So that applies to employment income, interest income, capital gains, dividend income. So again, there's a whole bunch of kind of what I always like to joke and say is if you're paying tax and you feel like you're paying too much, we can help. Again, the experience of our group, we currently maintain 70 commercial properties. We're one of the largest commercial landlords in Saskatoon. We've got 26 completed projects in Alberta and about 350 million of assets under management. Via distributions and project exits, we've also distributed about another 100 million over the years. But again, keep that in mind that basically the takeaway from the slide is that we're not new at this, right? We've got a tried, trust, and true kind of business model. We've done it numerous times, and we feel we've got quite good at it. 1,500 investors in the group, and they hold about 5,900 limited partnership units. So again, as a pure average, somewhere in that kind of 3 to 4 range is probably what people are currently holding. and over 50% are repeat investors. So how many is appropriate maybe for your financial portfolio? That's obviously why you're going to want to be working with the dealing representative. Whether it's suitability and concentration, they're going to help kind of calculate all those numbers and have those discussions with you. Because if you see what you like and you're interested in Millennium III and adding to your portfolio, and you decide you want $100,000 of this particular investment model, well, they can kind of help and say, maybe we should split it up into 3 or 4 offerings, or if it's a one-time tax event, maybe you do kind of split it amongst whatever we're offering this year. So again, working with that dealing representative is going to be very beneficial to find the right balance of what makes sense for your financial portfolio. Now, just to discuss quickly the 50% repeat investors, we think 50% is a great number as it is, but what that is that actually goes back all 41 years of the company. So what I remind people is the investment purchase price is roughly around $25,000. A $25,000 investment was a lot larger portion of somebody's investment portfolio back in the early 80s and 90s when the company was kind of young and growing, right? So we had a lot more one-time investors. And if you like what you hear, and this is a one-time investment for you, 100% no problem. We see that all the time, and that's absolutely appropriate for you. But there are a lot of investors that nowadays, if you're doing tax planning, you buy an investment this year, okay, that's great. Well, you're in the next year, you have the same job, you earn the same income. Again, you might buy another one to do more tax planning and more tax planning the following year. So a lot of our investors end up buying kind of 1 or 2 units per year, every year. And obviously larger numbers are appropriate if it makes it a suitable amount for you as well. So, but again, with the 50% repeat investor, I think it's a little bit deceptive again against me, even though I'm the one who calculated the number. What I did is I looked at all the numbers, all the investments from 2015. And I said, anybody who bought that year, was that already their second or greater investment with us? So again, they're already a repeat investor. Or if it was their first investment with us, did they invest again in the next 5 years, right? That number came out to 83%. So I think that kind of speaks to if you hear what you like and you like our business model, because the business model doesn't change, a lot of our clientele end up purchasing repeat investments year after year after year until they get to a point where they feel that they've kind of maxed out their allocation towards our business model. I like to point out that the principals and officers of Millennium III purchase units in every limited partnership. So they do this as a way to align their interests with that of the investors. So their money's on the table right next to yours as an investor. It's not something that they just keep a certain percentage. There's no discount, there's no commissions, anything like that are associated with their units. They buy units just like every single other investor. Now, that corporate guidance, the kind of team behind Millennium III, I do like to point out because I think there's a couple unique features in what we do. First is that it's an intergenerational company, right? So second generation, Everett founded the company back in the early 80s. However, he's still our chairman of the board. So Ev is in his early 80s, but again, somebody that has that many years of experience in the real estate industry is somebody that you're always willing to kind of, listen to what they have to say, because it's probably pretty important, right? Now, what I like to point out about this kind of second generation company is John, his son, is our current president. He's been with us for 28 years, right? So it's not a matter of Ev was looking to retire, just kind of looked around the table and said, hey, you're closest to me, so you get to take over the company at Thanksgiving. That's not how it works. John started on the job site, banging nails and cleaning up job sites, worked his way up the construction division, started to look into other divisions of the company, and kind of worked his way up to his role as president. So it's certainly a role that he's earned in this organization. He knows it back and forth. And again, the two of them kind of provide the umbrella management to the overall business, with Ev being that kind of advisory chairman role and John being the day-to-day president. The second layer of management that I think, again, speaks to advantages for our organization and what we provide is the vice president level. And the reason I think this is a little bit unique to us is the amount of years the vice presidents have been with Millennium III. Right? So Alan Lebjak is our CPA, CMA, VP of Accounting. He's been with Millennium for 29 years, right? So that's not 29 years being a lawyer. He's actually been with the company for 29 years. So he knows everything there is to know about refurbishing expenses, deducting them, T5013 tax slips, anything related to partnerships and taxes. He's pretty much an expert in, right? So that's the person obviously we want behind the scenes when we're kind of working on those tax slips and getting them out to investors every year. Mike Lalibert is our VP of Operations. He's been with us for 19 years. Now, Mike is the one person that I will talk about their additional industry experience. 19 years with Millennium is great enough on its own. The other 25 years is with one other landowner also in Saskatoon, right? So it kind of speaks to, he's had 2 jobs over his career of 44 years. all of it being leasing and property management. And we're lucky enough to have had the last 19 years with him. So again, obviously very loyal and very good at what he does. I'm a vice president. I've been with the company for 20 years. So again, I might look like maybe somebody who hasn't been with the company for 20 years, but I started with the company when I came out of university, and I liked what they had to say. I got the gift of gab from my father, and I just feel like every day that I go to work doesn't really feel like work. I'm just talking to people and kind of explaining what Millennium III does, and if it works, fantastic, and if it doesn't, that's fine too, right? So again, it doesn't feel like work, and it certainly hasn't felt like 20 years. The final vice president is Jarvis Ryan, VP of Finance for 19 years, and again, 19 years with Millennium. So I think what's important about this is that, again, it's a long-term team that's coming with a long-term investment. So people that invested, 15 years ago, I'm still the person that they're talking to when they have questions, they want to talk about their investments, things like that. I'm still the person, and I certainly expect I'll still be the person for another 20 years, right? So, that's the kind of takeaway, that when you're investing with a long-term organization, we certainly have all the right pieces in place to still be here in a long-term fashion. Important to know that there's an independent director for the offering. So again, his name is Daniel Bollinger. So the takeaway here is that it's not just Millennium doing what Millennium wants to do. There's somebody kind of always looking over the shoulder, doing, making sure that we do what we say that we're going to do. So he's a director of financial services of Sask Water, and has got about 20 years of experience in both the public and private sector. So certainly a good person, kind of, always looking over the shoulder on behalf of investors. Now, the Millennium kind of business model or structure, I would say, kind of financially looks like this. So again, if you're a repeat investor, you've done this before, you'll notice that this is all familiar. If you're new to the concept, once you memorize kind of these 4 things, you know what the last 5 investments have looked like, what the next 5 investments will look like, because this is part of the financial features that we keep consistent. So you don't have to relearn things, relearn the numbers, kind of start from scratch every time. This is why we're vetting 50 to 100 properties and only getting down to 2 or 3, because if it doesn't meet these criteria, we just don't bring it to investors. Even if it's a great property, it might be a great property for somebody else. So the purchase price of each limited partnership is $24,700. So again, conversationally, you might catch me saying 25,000. It's just for ease of numbers and roundness and things like that. But again, when you write the check as an investor, it is for $24,700. The first year tax deduction is about $12,000. So again, that's that kind of that tax planning part of what we do. Just keep that in mind, that when you're investing, the year you invest is the year you get tax deduction. So again, if you're investing in 2022 before kind of that mid-December cutoff, you will get that tax deduction for your 2022 tax year. Now, the mortgages on the property are typically paid in about 14 years. I kind of mentioned this a couple points through the presentation. So that's that kind of timeline of, money comes in from tenants, goes to pay off the mortgage. There's a little bit left over that goes out to investors. So again, I'll circle back to that one. But what people really want to talk about when they get excited about is, well, what happens the year after the mortgage pays out? What happens in year 15, right? So that's where, again, the second point on this slide is that, typically once the projects are paid out debt-free, each investment unit, so each of those $24,700 investment units, is expected to produce about $5,000 of net rental revenue per unit per year, right? So now the per unit per year is something that I like to point out is, that's what happens year 15, but year 16, the tenants are still there. They're still paying rent. We're still paying out cash to investors. It's probably the same. Year 17, year 18, maybe by year 19, rents have gone up a little bit. So now the payout to investors grow as well. Now, what I wanted to touch on, kind of circling back, is from years 1 to 14, it's not that there's no cash flow associated with the investment. It's just low cash flow. In normal investment circumstances, if everything happens as we expect, there should be about $400 per unit per year that goes out to investors. So again, from years 1 to 14, you might be getting two $200 checks twice a year. It doesn't feel like a lot, but it adds up over that amount of time, right? So it might be $5,000 or $6,000 over that period of time. So again, keep that in mind. It's not a no cash flow, it's just a low cash flow. And again, working with a dealing representative can help you with that, because they might have other investments that are more about producing cash for you today, and Millennium III is maybe more cash for you tomorrow, right? So investments used in combination can obviously have some significant advantages. Now, that's the background. That's Millennium, the history, the business model, all those wonderful pieces. What now I'm going to tell you about is the current offering, because I think it has some really exciting attributes. It is a Saskatoon-based offering, so it's 2 commercial properties. They total about 35,800 square feet. They're light industrial tenancies, and it's about 86% occupied. Okay, so this is what the properties look like. It's typical light industrial uses. This is what light industrial properties kind of look like. And the part of it, the takeaway is that light industrial properties aren't lighting the world on fire from a beauty perspective, right? They're typically not the most attractive properties because that's not what's important to a light industrial tenant. So again, that's kind of our wheelhouse, right? We like properties that don't necessarily look the greatest because we can spruce them up and increase value, sometimes on the inside, sometimes on the outside. But that doesn't mean the tenants aren't great for those properties as well, right? So in this particular property, it's one of the two. It's on Miller Avenue in Saskatoon. It's got Sunview Windows, who's been in the building for about 20 years. Well known, again, definitely in Saskatoon, but also in other places in Saskatchewan. I was talking to somebody in Regina that got their windows and doors from Sunview. So again, they've been operating for many years. That numbered company there is actually a carpet wholesaler in another portion of the building. So again, obviously nobody's ever heard of that numbered company, but in a growing economy, again, carpet wholesaler is going to be doing good business, and that's what is important for them, right? If their business is good, they can pay us rent, and life is fantastic. There's one available bay in this property. So again, that's part of that refurbishment. If we're going to go in, we're going to spruce things up, we're going to get that bay rent ready and get it out to marketplace. We're not overly concerned about the available bay. We think it'll lease up pretty quick, and you'll hear about that why very shortly. But again, so there is a little bit of work to be done in the property. That's where a lot of it will center. And now the other piece is the second property. It's on First Avenue North in Saskatoon. It's got a single tenancy with Harlan Fairbanks. They pay the rent on the entire building. Now, again, some properties like this, it's important to point out that today it has one tenant that leases the whole space, but it can be subdivided into 2 or 3 bays if that tenant were to ever leave. Now, we have no knowledge that they're leaving. They've similarly been there for 20 plus years, but it's just one of those where keep in mind that, the way a property looks today doesn't mean the way it might look in 5, 10, 15, 20 years. Like, we have the ability. And we know that for sure, because if you can follow my cursor, if it shows up on the presentation here, this section of the building is actually subleased to a tenant that does like woodworking, resins, and things like that, right? So from our perspective, it's a little bit easier. Harlan Fairbanks pays the rent on the whole building, and they collect whatever they collect from that particular tenant, right? So, and again, industrial tenancies might not, that main name might not mean a lot to you, but that doesn't mean it's not a very strong company. Harlan Fairbanks itself does kind of like convenience store products like slurping machines and those rollers for hot dogs, things like that. That's kind of their business model. But they've got 5 locations across Canada, but they're actually part of the Premium Brands group of companies, and they have about $5 billion of revenue on an annual basis. So again, the parent company behind this tenant is incredibly strong, but you've probably never heard of Harlan Fairbanks, right? And that's fair. In light industrial uses, that's very common, right? Even if you're a different geographic location in Canada that has its own Harlan Fairbanks branch, you probably wouldn't know about it unless you're a convenience store operator, right? So doesn't mean it's not a very viable business, and obviously has a great covenant behind it as well. So where we get particularly excited about this this property is, again, the property's not, it's not incredibly beautiful. It's not going to jump off the page and be like, wow, I got to get into this. It looks so good, but it's the numbers. It's the financial bits and pieces behind it, right? So we've got a property that's got good occupancy and has the ability to get better, but the market behind it is incredibly strong right now, right? So that's why we're talking about that vacant space. We don't think it's going to be very long, and you'll see in a short minute here why. We have industrial surveys from some of the larger, external leasing companies, Colliers, Cushman Wakefield, ICR, which is local to Saskatchewan, but they probably manage the most properties in Saskatchewan, and CB Richard Ellis, right? So, major names in the commercial leasing and sales space. Colliers survey, it does of Q1 2022, has City of Saskatoon vacancy at 2.5%. So again, the flip side of that is it's 97.5% occupied. Everything is basically, full. Average asking rate of about $12. And again, you can see here a little bit kind of closer is that the 2 properties where they are in Saskatoon, one is in the Hudson Bay industrial neighborhood, which actually has a vacancy rate of 1.9%. The other is in the North industrial neighborhood of 1%. So very, very strong occupancy in those neighborhoods. So again, if a property were to come available or a space would come available, it's probably going to be leasing up pretty quick, right? So again, even year over year, vacancy has dropped to 110 basis points. And again, asking rents have gone up about 14%. So again, the supply and demand in that neighborhood really makes sense. And sorry, not just in that neighborhood, in Saskatoon overall, and even stronger in that neighborhood. Now, Cushman Wakefield survey was Q2 2022, a little bit more current. They had City of Saskatoon at 2.86%, but again, similar average asking rate. They all have different data points, right? Because their data points is really the properties that they know about or they can get data on. So again, keep that in mind. That's why there's a little bit of variance, but you'll see it's very consistent from group to group. With ICR, Q2 2022, City of Saskatoon is 2.52%, average asking rate of $12. But again, here's a great survey that shows that everything going back to 2016, right? So you can see the vacancy rate dropping here pretty much on an annual basis, getting to that 2.52% in Q2 of 2022. But then you kind of see that tipping point right here around that kind of 7% vacancy where you start to see rental rates climbing, right? So that's supply and demand. If there's less of something, the existing ones are worth more. So we see that kind of arbitrage taking place right now. And that, you know, as an existing real estate owner, and again, a new offering that is in this marketplace, it's a great time to be in the light industrial real estate space in Saskatoon because there's not a lot of it, there's not a lot available, and that causes rental rates to go up. The other piece that I liked out of the CB Richard Ellis survey was in March of 22, before anything was happening in kind of, you know, Ukraine or anything like that, before some of that got factored in, they forecasted ahead for 2022 of 4.1%. I think that's obviously a little bit stronger now. But the takeaway from them is that we're running out of industrial supply. It's been getting stronger and stronger for the last number of years, but at the same time, whether it's supply chain issues and whatnot, there's nobody coming in and building another, like, you know, 1 million, 2 million, 5 million square feet of space speculatively to take advantage of this marketplace. So it's continuing to be strong, and it will remain strong for a number of years because of the time it takes to build new properties and nobody really coming in and flooding the market. So it's a great time for the short term to be in this space. Well, again, just a few headlines that came out of it as Saskatoon industrial sector defies the pandemic. Saskatoon will lead growth in economic, or lead Canada economic growth in 2022. That was out of the Western Investor in June. And this one is one that I liked as well. It came from a 2022 REMAX commercial real estate report. REMAX you might associate with residential real estate, but they do commercial as well. And says a dramatic increase in several asset classes has contributed to Saskatoon's robust commercial real estate market in the first quarter of 2022. Multifamily, residential, industrial, and farmland are experiencing unprecedented growth on the cusp of what is expected to be the most significant economic expansion in Saskatchewan in decades. So again, we are on the cusp of something that is about to start and get so much stronger. So the marketplace right now is incredibly strong, but they're talking about this continuing for decades. So what is causing it to continue for decades, right? So we've been saying for years, Saskatchewan has a wealth of resources. That's really why the principal of the company came over and settled here. He's actually from Newfoundland. He came from Newfoundland to work on the Key Lake uranium mine. He's got a background as an engineer, and he settled in Saskatchewan because of, you know, the vastness of the resources that he saw here, right? So, you know, where it looks kind of in today's perspective is there's still continued pandemic supply chain disruption. There is now an invasion of Ukraine that's changing a lot of global markets for various commodities, and there's a growing number of protectionist economies. So the underlying piece is, and you'll see shortly for the next few slides, Saskatchewan has what the world needs right now, and we're open for business. And these aren't short-term needs either, right? There, a lot of them are very long-term needs. So again, you know, I'll tell you about a few of the pieces here. So agriculture, right? We have to feed people in this world. Saskatchewan is Canada's leading agricultural exporter and expected to be about the third largest harvest in the last 100 years. So again, you can see here in kind of, you know, February, again, if my cursor shows up in February, things really kind of peaked and spiked with both wheat and canola. They settled down a little bit more, but they're very much in high demand. The per unit price is pretty good, but also it's expected to be a robust harvest. So there's a lot of it that we can send out to the world. So again, you know, good to be in that kind of position right now in Saskatchewan. Potash. If you're not familiar with potash, it's basically fertilizer, and Saskatchewan is the world's top potash producer, right? So not only is the per unit going up of potash per ton, but we're actually ramping up production to meet global demand. So you can see here from the chart here at the bottom, the purple was about 2020. We saw about just under $400 per ton. It started to ratchet up in 2021, and then the red line here is 2022. So, you know, it started out over 800, it's approaching 900. You know, that's where potash per ton is. So it's almost doubled in the last 2 years. Plus, Nutrien, the largest distributor, is looking at ramping up production by 1 million or 2 million tons on an annual basis. So again, that much more is, it's good jobs, it's good income, it's good money flowing through our economy, and it's obviously something that is globally needed. Oil and gas, we're the second largest producer of oil in Canada. So again, and what we have is politically stable oil. So I didn't even kind of mention, I apologize, in the last 2 slides about the effect of the invasion of Ukraine. Ukraine can't get its corn, its wheat, its things like that. Like Ukraine is kind of the breadbasket of Europe. It can't get things to marketplace, or it's having a harder time doing it. Russia also has a lot of agricultural exports. From a potash perspective, Russia is a large distributor of potash in the world, but now people don't want to touch it. People don't want to deal with it. So that's why we're seeing kind of such an increase in demand and a per unit rate increase. The exact same thing applies to oil and gas, right? Europe is somewhat dependent on Russian oil and gas, so they're trying to move away from it. They can't do it short term, but they're definitely trying to move away from it as much as possible. But we all know what gas was doing through 2022, right? We're either paying for it at the pump, or if you drive an electric vehicle, you were kind of laughing at the rest of us paying for it at the pump, right? So, and that's, again, the biggest takeaway is we have that politically stable source of oil and gas, right? So again, getting it to global markets as quickly as possible and as sustainable as possible is obviously important. Now, the next couple are more of that clean energy. So, with climate change and things like that, I think we can definitely do better, and we have to kind of make some tough decisions and get there. But some of the way that we can get there, again, from an energy production perspective, is by moving to things like uranium and nuclear technology, right? So we've seen California didn't shut off their last nuclear reactor because they needed more baseload power. Japan, after their Fukushima nuclear disaster, they said that they were going to get away from nuclear. They've actually changed course on that, and they're going back to nuclear technology because they feel like the alternatives of coal or natural gas aren't going to help climate change, and they have to kind of just find a way to do nuclear better. And similarly, Germany's kind of gone reverse course, that they're obviously going to get back to their nuclear reactor technology as a supplier of major energy for their economy. And at that time, India and China never stopped their nuclear reactor technology. So again, it's their energy. This is going to be one of the ways that we can kind of green up our economies and whatnot, is by switching to nuclear power, which needs more work and more investment, more infrastructure. Don't get me wrong, but what's existing there, again, just in the last year or so, we've seen gone from like $300 up to $30 to $50, right? So again, that's a pretty significant increase over a short amount of time because it's in demand. And Saskatchewan is the world's top uranium supplier, right? We have what the world needs. The final piece is rare earth minerals. Again, not a lot of people know these things by name, but basically, if you want the magnets that go into electric vehicles and wind turbines and all the electronics that are in our hands every day, it has to come from somewhere. Right now, somewhere between 80 and 90% comes out of China. Well, in Saskatoon, they just opened the first Canadian processing facility. There's actually a second processing facility in Saskatoon that's opening up in about another year. The two of them together will have about 100 good jobs associated with that. And again, the only other plant in North America is in, I think, the southern US, right? So again, it's very much, something that we need. And if China ever decided that they don't want to supply it anymore, we're out of luck, right? So getting into this kind of global marketplace and kind of, diversifying what we do and how we do it, it's obviously something that's still going to be in high demand as we kind of move towards that greener economy. So the exciting part is all those things come together, and they really speak to Saskatchewan is growing, and it's going to continue to grow for a long period of time. So in mid 2022, RBC said Saskatchewan is going to lead Canada in growth to be about 6%. We made it to the pages of The Economist, again, a global kind of discussion there. It refers to Saskatchewan as a remote Canadian province. So I don't know, I find that to be a little bit funny, but I guess in some ways we are remote. But even more recently here in late August, the Canadian Conference Board said that Saskatchewan will lead the country in real growth at 7.6%. So again, increasing those numbers as well. So, at the end of the day, Alberta's second, it's 4.9%. We still love our properties in Alberta as well, but that's why we've invested in these underlying commodity back. Like, we're not invested in commodities as an organization, but the commodity backing of these economies is significant for what we do, because at the end of the day, we have what the world needs. It puts money into our economy that spreads out through the economy. It puts demand on commercial real estate. estate and allows us to increase rents. And that's obviously how we're making these into profitable investments for our clientele. So final kind of summary on the Hazelton offering, it's 110 total units. The principals are purchasing 8 units. So again, keep in mind they purchase units in every limited partnership. So they can never invest, too much into one. And there's, specific reasons in the Income Tax Act as to why. But again, what they've done is they're making a significant investment into all our LPs, but not kind of putting preferential treatment on any of them either, right? So they're buying 8 of the 110. That means 102 are available to the public. It's only available for non-registered funds. So again, if you have RSP or TFSA room, your Raintree dealing representative and private wealth advisor will certainly be able to help you with that, just not with this investment. And again, we expect this investment to sell out probably sometime in November of 2022. So if this is something that is of interest to you, get in touch with them, have those conversations. If they need to reserve a unit, they'll get in touch with me. But again, if this is something that makes sense for your long-term financial future, get in touch with your dealing representative, and we can have those further discussions to see how this might fit into your portfolio. So thank you for taking the time. I really appreciate you taking the time to hear me discuss both the Millennium III business model and our current opportunity. If you do have any questions, again, I certainly encourage you to contact your dealing representative. But at the same time, if you do have any direct questions, that's my email address there, Gerald with a J at millennium3.ca. Millennium is 2 L's, 2 N's. And that's my cell number, 306-241-8658. I'll certainly answer any questions for you. Obviously, any investment that you're looking to make does have to go through your dealing representative, but I'm always happy to answer any questions.
Awesome. Well, yeah, there we are. Thanks so much, Gerald. Really appreciate it. That'll be a wrap here on our investments in focus with Millennium III. Thanks again for joining us and for the presentation. I suspect these units won't last very long, as you mentioned. So if you do think that this is going to be a good fit with your portfolio or want to discuss how it might fit into your portfolio, reach out to your private wealth advisor, and we'll see if that's a good fit. Thanks for joining us.